Hello. I'm going to be talking about foreign earned income exclusion and the foreign tax credit. We see the foreign earned income exclusion less than we see the F bar and the 8938. But this is still just a good topic to know about and maybe learn some keywords to look out for if you need to possibly ask some follow-up questions. So what is the foreign earned income exclusion? This is a tax benefit that allows a US citizen or a resident alien to exclude some income from tax. To qualify, you need foreign earned income, and I'm going to go over in the next slide what is earned versus unearned, and your tax home must be in a foreign country. So just like in a regular 1040, it's the same rules that apply. Earned income is going to be your salaries, commissions, bonuses, something you actively earn. And it's not going to include your unearned income. This is dividends, interest, capital gains, social security, pensions. None of that is going to be a part of foreign earned income. In addition to the first two qualifications mentioned, the taxpayer must either meet the bona fide residence or physical presence test. A bona fide resident is either a US citizen who resides in a foreign country for an uninterrupted period that includes an entire tax year, and the physical presence test requires you to be in a foreign country for at least 330 days. The difference in these two tests is the kind of residence you have and the intention of returning. So a quick example of that is you could have your home in Ohio and a residence in Scotland. And if you go to Scotland as a tourist, or even if you go on a short-term business trip, you don't establish a bona fide residence by staying there for just a little bit in Scotland. But if you were to go to Scotland for an indefinite or an extended period and you set up permanent living quarters for yourself and your family, you probably have established a bona fide residence at that point. Even though you might eventually intend to return to the United States, you are residing and living in Scotland for an extended period of time. So that was a lot of qualifications, but let's say that we do meet all of these requirements. The next step is going to be to figure the exclusion. And for tax year 2023, the foreign earned income exclusion cannot be more than the smaller of 120,000 or foreign earned income for the tax year minus any housing exclusion. This is going to be reported on Form 2555, and these amounts are adjusted for inflation every year. And we have a link in our references if you ever need to look up the most up-to-date information for these numbers. So the foreign housing exclusion and deduction. We see this even less often than we do the foreign earned income, but just something to be aware of. This is where the taxpayer can exclude or deduct certain foreign housing amounts. This is going to include rent, insurance, utilities, but not mortgage. This is going to be limited to the lesser of foreign housing costs paid, or the amount of you can't exceed your foreign earned income. For purposes of determining the housing exclusion or deduction, a taxpayer cannot consider housing expenses that exceed a certain limit. The limit on housing expenses is generally 30% of the maximum foreign earned income exclusion, but this can vary depending on their location. So the foreign tax credit, we're not going to go too much in depth into the foreign tax credit for this presentation, but just a high level, this tax credit comes from foreign taxes you paid. This is going to come from your brokerage statements on 1099s, the foreign taxes you paid on interest and dividends. This is reported on Form 1116. And the important thing to know is that you can either take the foreign tax credit or the foreign income exclusion. They cannot be combined. And so we're just going to compare the two really quick. The foreign earned income exclusion and the foreign tax credit are two of the most popular tax advantages when dealing with foreign accounts. However, they are not the same. The foreign earned income exclusion is going to allow you to exclude a certain amount from your U.S. taxable income. This lowers your total income on which tax is calculated. On the other hand, the foreign tax credit is going to reduce the tax you owe to the United States dollar for dollar based on the amount you have already paid to a foreign country. Just to restate this again, you cannot take the exclusion and the credit. So if you exclude your foreign earned income on the exclusion, you can't also use the taxes that you've paid in that country to qualify for the credit. And then here are the resources if you ever need to look up your most up-to-date numbers. Do we have any questions?
Hey, Shelby, yes. If a client lives overseas, do they have the same filing deadline of April 15th?
So actually there is a special extension if you are a US citizen or resident alien that's living outside of the United States or Puerto Rico, or you're in active duty in the military. There is a 2-month extension until June 15th to file and pay your tax due.
Thank you.
No problem.